An average Indian middle-class family spends 40 to 70 lakh rupees in their lifetime on things they proudly call investments. But most of these things never make them richer. In fact, some of them quietly destroy wealth for 20-30 years. And the shocking part? Educated, hard-working, financially responsible people fall into this trap every single day, thinking they are securing their future. So today, let's talk about 5 assets the middle class believes are investments but actually aren't. The Indian middle class has one financial goal: security. Stable job, own house, insurance policy, gold for safety, car for comfort. Everything feels responsible, logical, safe. Because this is what we were taught growing up. Parents said, buy property early. Insurance is investment. Gold never fails. EMI means progress. But here's the uncomfortable truth. Most people are buying liabilities disguised as investments. And the system encourages this thinking. Banks earn from loans, insurance companies earn from long policies, car companies earn from upgrades. Nobody benefits when you quietly invest in wealth-creating assets. So people end up working harder every year, yet their net worth barely grows. Let's break this down simply. Asset 1. Self-occupied house. A 80 lakh house bought with a loan. Down payment 15 lakh, loan 65 lakh. EMI for 20 years, approximately 55,000 rupees a month. Total payment after interest, almost 1.3 crore rupees. Now ask yourself, does this house generate income? No. You still pay maintenance, tax, repairs. Yes, property price may rise, but so does every other property. You still need a place to live, so practically it behaves more like an expense, not an investment. Asset 2. Traditional insurance policies. Example, you invest 50,000 yearly for 20 years. Total invested 10 lakh rupees. Maturity value around 15 to 16 lakh rupees. Sounds okay until inflation enters. At 6% inflation, that future 16 lakh rupees equals roughly 5 to 6 lakh rupees today. Your money grew, but your purchasing power didn't. Asset 3. Expensive car. 15 lakh car, loan EMI plus fuel plus insurance plus maintenance. After 7 years, resale value approximately 4 to 5 lakh rupees. That's massive depreciation. A car gives comfort, absolutely. But financially, it's a consumption expense, not wealth creation. Asset 4. Gold jewellery. Indian families love gold. But jewelry includes making charges, wastage, design cost. You may lose 10 to 25% value instantly when buying. Gold ETFs or sovereign bonds behave differently, but jewelry, mostly emotional wealth. Asset 5. Idle savings in bank account or FD. Feels safe, but FD return 6 to 7%. Inflation 6%. Real growth almost zero. Your money is running on a treadmill, moving but going nowhere. This happens because middle-class decisions are driven by fear, not strategy. Fear of uncertainty, fear of emergencies, fear of social judgment. Owning visible assets gives psychological comfort. A house signals stability, gold signals security, car signals success. And institutions design products around this psychology. Loans are marketed as achievements, insurance as investment, EMI as affordability. Because predictable consumers create predictable profits. Even intelligent people fall for it, not due to lack of knowledge, but because these decisions feel socially correct. So what should you actually do? Rule 1. Separate investment from lifestyle. Ask one question: does this asset put money into my pocket? If not, treat it as an expense. Buy it consciously, not emotionally. Rule 2. Insurance is protection only. Take pure term insurance, low premium, high coverage. Invest remaining money separately instead of mixing insurance and investment. Rule 3. Delay lifestyle inflation. Before upgrading house or car, build investments equal to at least 3 to 5 years of expenses. Let assets grow first, lifestyle later. Rule 4. Invest where growth beats inflation. Examples: equity mutual funds, index funds, retirement investments, skill development. These may fluctuate short-term, but historically create real wealth. Rule 5. Focus on income-producing assets. Assets that generate income, appreciate faster than inflation, work even when you sleep. That's how wealth compounds. The middle class doesn't struggle because it doesn't earn enough. It struggles because it confuses ownership with investment. Buying things feels like progress, but real financial freedom comes when your money starts working harder than you do. So next time someone calls something an investment, pause and ask one simple question. Is this making me richer or just making me feel richer? If you found this useful, share it with someone who's building their future one EMI at a time.